want to talk about is how do we communicate to our clients, because we're often on both ends, and sometimes on the same with the same client, we're on a buy and a sell. So I think the way that we communicate, hey, where's the market at now? Can we continue to do the behaviors that we've done the past 18, 24 months and still succeed? I'm going to say probably less so right now as we sit here today with Robert. What were the numbers for the county? If you could repeat them for the group.
So new listings in April were about 400 to maybe 450 for the whole month of April. And so far this month, from May 1st to May 20th, there are 500 new listings.
So, and if that trend would follow out, that would be 750 over a little under 450 in new inventory coming on. The month's inventory is still relatively low, so it seems like the market's absorbing a lot of those, albeit with price reductions instead of increases. Would you agree on a overall on that statement?
Yes.
So this comes back to when Darrell Davis was preparing for our sales rally. He was talking to a few agents to try to get a feel for what were some of the biggest challenges, and there was one conversation that our group of agents had mentioned to him that totally set him off the chart, and it was something like this: "Hey, Darrell, I'm having trouble getting listings because a seller could put it on and sell it themselves, and boy, did that open up the spigot of comments." And I think sometimes, maybe not, consciously, but maybe subconsciously, we're thinking, how much do sellers need us? Does anybody care to admit that that's, a possible thought in your head? And if somebody sells it on their own, they put it on Zillow or sale by owner, or even a paper sign in front of their house that they could probably get the job done.
Oops, I don't know how.
Is that you, Ron, talking?
Yeah. Can you hear me?
Not really.
It's that something's wrong. Hold on, let me adjust this.
Okay. Anybody else in that camp where you're like, hey, actually, I see you're on there twice, Ron. Yeah. So I know there are some of you out there who are feeling that way. A seller can go and put it on Zillow, and they can save the commission that they would otherwise pay, or sometimes they shrewdly offer to pay 2.5% if you bring me a buyer, or 2%. And I was thinking about that when I was helping some agents negotiate contracts, and man, the homeowner has no idea what we do as an industry. Okay, putting it on and exposing it to the market is just the tip of the iceberg. If that iceberg is 95% under the water, and what things can possibly go wrong when you're trying to sell that house on your own? What are some of the things that we're seeing in contracts now that are the terms that make or break a deal?
Inspections and appraisals.
Inspections, appraisal waiver, right?
Yeah.
Huge. Now, even if you do an appraisal waiver, how many times are we leading an appraiser or helping to dispute an appraisal if that comes in low? Is that still one of the services that we provide? Helping limit inspection items, all these things that we do provide tremendous value and a tremendous position for us to capture business when we have those opportunities. And now that inventory is increasing, I think our value as a listing agent is even more critical. And what have we been hoping for when we work with buyers?
You have a lot of cash.
I'm sorry?
Market.
What's that, Colleen?
We've been hoping for a market where there's more listings.
Yes, where you can have a couple of extra properties to sell. So I do think that, we're going to be transitioning into that, and it could be, you know, when the market shifts, if we're not ahead of the curve, you know, we're missing out on an opportunity. Okay.
Something else that we've seen, I was talking to some agents yesterday, and they have a lot of buyers that now want to sit on the fence waiting for the big crash, which I think we need to, you know, talk about how there really isn't going to be a big crash, just a leveling out. And if they wait, it will probably in the long run cost them more money.
So here are some things that I would suggest that we talk about when somebody's worried about or trying to be an opportunist, hoping for the big crash. Okay. And the reason why they, Colleen, all kidding aside, the reason why they think the big crash is coming is because, you know, many of us have maybe not been in real estate sales, but many of us were on planet Earth when 2006, 7, and 8 came, right?
Yes.
And we saw a very painful adjustment to the real estate market in a very quick, short period of time. Now, there are several fundamentals that are voting against that. And I don't want to speak those. I want to see what you guys come up with, because these are things that should be on the tip of your tongue when you're talking to your clients, whether buyers or sellers. So who wants to give number one? And Bruce, you're excluded. You were at the meeting yesterday.
There's a lot of equity now in the homes, whereas there wasn't before.
Yes.
And the buyers have been really qualified, whereas before anybody could get a mortgage.
Like back in 2006 and 7, everybody was using their house as a piggy bank. Everybody was taking all the money out, leveraging it to 120%. And once the market tipped, it was like a stack of cards just crumbling. So that's number one. What would number two be? All right, we need to know, like, everybody's just being bashful because we need to know this immediately. Number two is, Bruce, what kind of loans were they giving in 2006 and 7? Were they not called liar loans?
Stated income, not really vetted approvals, you know.
Teaser loans.
They were just giving away money to keep the market going is what it boils down to.
I call them fog-a-mirror loans.
And how many fog-a-mirror loans have you done recently, Colleen?
None.
So there's none. Now, a third critical component, that these are the three things that come to my mind when somebody says, I want to sit on the sidelines and wait for a crash, right? The country has a normal population growth, and it also has a household formation growth. So there are two factors. We have the millennials and the next generation getting into home buying, and home building has been way behind the curve and continues to be behind the curve because now we have pandemic shortages. Is it easier or harder in your neighborhood to get a subdivision and build 5 new houses or 30 new houses? Like who has sold a developer a tract of land to build 30 or more homes on this call? Anybody? In the past 5 years?
Not in our area. We ran out of land. Very few, northern Florida might be better.
So Southeast Florida is running out of land. New Jersey's running out of land. The only new construction that we have is tear down and rebuilds or complete renovations and flips. Or if you're lucky, you might take one house and get 2 out of it, but it's not keeping up with the population. So in terms of, you know, criteria for a crash similar to 2008 or even the 2001 recession that we had, I don't think the statistics are there for that. I will say that one of the markets that I took notice of just because I saw the post was up in Toronto, which was one of the hottest markets in North America. The market has cooled off a bit. And that happens to be where my business coach is located. And, the headline is trying to be very dramatic, saying that, the average house in downtown Toronto, I'm going to use my calculator because I know the number, but I don't remember what the multiple was. It was, so the marketing time for the average single family home was up 600%. And the average home price for a particular month was down almost $200,000 in Canadian dollars. Now, what that meant was the average days on market went from 8 to 45. Okay, and if you've been in real estate for a longer period of time than 3 years, then 45 days is probably a very ambitious, healthy market. And the housing prices were down 200,000, but they were only down to where the market was 6 months ago. So it went from 1.25 to 1.45 average sale price. So it took a 6-month step back, and the marketing time, probably just due to the fact that sellers were sticky, wanting to get those higher prices, went from 8 to 45 days or 8 to 48 days. I think that's a healthy market, not a collapsing market. Now, we're all going to be given these stories of the market's going to crash. Somebody around the coffee pot's going to say, in for an epic crash, sit on the sidelines, wait before you buy. Some of our buyers are going to be saying, hey, let me wait for a bargain. The bargain's coming. I see the stock market's going down. Interest rates are going up. The houses are going to be on sale dramatically very soon. I can't predict the magnitude of it, but I don't think we're going to be in for a major crash. And I do think if we do see softening, that, Bruce, you probably comment on this, the Federal Reserve will probably step back in and try to balance that inflation, economic health needle that they're doing.
Yeah, there's two more rate hikes scheduled, before the one in September. And, the idea of this whole thing is to try to stop inflation. The initial jobless claims was up very slightly last month. They did, the word that it might be out there is the word pause. They're supposed to raise it three more times. They might only raise it 2 more times, because as the stock market gets beat up and, as things start to digress, that could change. Existing home sales last month, existing home sales are homes that already are here. They exist. It's about 90% of all the homes on the market, right? So last month, they were down about 2.4%, so when you think about a 10% increase in inventory, Rob, which is what it was nationally, it's not that bad. But keep in mind, people that, last month's numbers, people were looking in February, March, so interest rates were a little bit better than they are now. First-time home buyers made up about 28% of that market. Cash buyers was about 28% of that market. And investors were about 17%. All those numbers also dropped this month as well. So it's starting to work a little bit, where inflation's getting, things are starting to get a little scary, but there's still tremendous, the average number of days on the market for a house was 17 in April. So the earnings are still up, prices are still up, and the houses are still flying off the market, even though, there's a little more inventory. The ones that are on, 88% of the houses are selling within 60 days.
I also think there's another component. The fact that homes from 60 days, 30 days ago, when they went in under contract, are now closing at those high prices. So when sellers and even appraisers and everyone else looks at the market, they're not going to see that drop. They're going to see that, that higher price. So the person that's waiting for the lower price is not going to see that. There's also
more buyers come into the market, and rates will go up too. I mean, rates will come down and more buyers will be in the market. So it kind of offsets each other.
Exactly. And they can always take an adjustable. And then when the rates go down, refine.
Mortgage rates have dropped about 0.25% since the Fed cut. So just so you guys know, that's kind of how it works. Negative economic news helps mortgage rates. The increase in rates was all to avoid and it just freaked the market out because it was scared of all this stuff. Once it starts to get under control, rates typically come down.
Well, and in Florida, we have, we're always behind everyone else when things happen in the market, so to speak. So I really feel down here, Southeast Florida, that we're not going to see that drastic of a change. First of all, we have no state tax. We have, when somebody's buying for their own home, we have our property taxes can't, they can homestead and they can, lock in at a certain rate. So, I mean, we have so many advantages here. God willing, we don't have a hurricane season. Most of the hurricanes, unfortunately, have been up north. Well, no, that you have any hurricanes. But Florida is going to, I think, stay pretty steady.
So Colleen, basically all this chatter about a market crash is noise. Okay, because what I've heard in the past 18 months is, God, please give me inventory to sell. And now we're getting some there and we're letting our buyers get spooked.
Yeah.
Right? I mean,
I want to correct something I said. I said the rates have dropped 0.25% since the last Fed cut. I mean, since the last hike back in the middle of 2 weeks ago. I didn't mean to say cut. So, yeah.
So, this inventory having, if we were to get 30 days, 75 days, 60 days of inventory, that would help us clear out our true buyers that are committed to buying. And we need to have a talk track. We need to have a communication strategy on what this means. And what it does mean is, let's take two strategies, or let's take two scenarios here. If scenario one is if interest rates continue to go up, right? So we saw them go up about 2% in 3 months, Bruce, is that about right?
A little more actually, but yes.
So, most of it came in the past 2 or 3 month period, and you've seen a dramatic increase in interest rates. So let's just say the next 6 or 9 months, we see a similar change. Interest rates go up another 2%. Now, Colleen, would that person that bought today at 4 7/8 be glad they did when rates go up to 7?
Absolutely.
Okay, so is that not a win?
That's a huge advantage. Yes.
Now, what happens, Colleen, if they buy now at 5 and interest rates drop back down to 3 1/4?
They refinance.
Now, is that a win?
Absolutely.
So how does a buyer lose here?
They don't.
Okay, the interest rates is crowding out a little bit of the buyer activity, making it possible for people to have more than 24 hours to make their highest and best offer in many cases. It may give them 3 houses to take a look at in a weekend instead of 1. And I think this is a total, huge, massive benefit to our industry and the clients. But what's going to happen is we're going to let other people control the narrative by saying, oh, let me wait until the market crashes, then I'm going to get in, right? And
Well, what I said to one of our agents yesterday was, how you need to explain it to them is tell them the facts, what's going on, just like you just said, Rob, and then say, I'm only telling you this because I don't want you to turn around in 6 months from now, say, John, why didn't you tell me this? Why didn't you tell me that I won't be, getting this advantage that I would have had 6 months ago? So, and I don't want you to be mad at me. So I'm telling you.
So there was an agent that was buying up in one of our Bergen County offices, buying a house for themselves. And when they first went under contract, they were at 2 7/8, 3%. And then they went up 1/8 or 1/4, and they're like, well, let's wait a little bit, it'll come back. Then it went up 0.5%. And the rep with Bruce made them lock it in. Like, you guys stop playing the game, lock the rate in. And they were really upset at that time. They called me up, I can't believe this. They're, I'm paying 0.5% more. Well, fast forward to now, they closed 2 weeks ago, and they're like, oh my God, that was the best decision we ever made. We locked in at 3 3/8. Now the rates were 5 1/4. So the narrative that we have with our clients is ours. Okay, don't let them drive the narrative saying, I'm going to you know, some buyers are saying, hey, I'm gonna, you know, try to make 20,000 below ask price offers because the market's gonna crash. That's not the reality. As a matter of fact, the statistics tell a greatly different story. And I think we owe it to our clients to share with them the statistics. And in this environment, Colleen, you nailed it. If the rates go up and you lock into a fixed rate now, and for some reason we go back to a 6 or 7% normalized mortgage market, you're a genius. You locked in, you know, it went up a little bit, but you locked in at a low rate. And then if rates decline, like you said, you refinance and you take advantage of the lower rates. You do not lose.
It's
So-
a win-win.
So this is a great story that we need to share with our clients. And clients who are in that pinch point where when they qualified, you know, let's say they qualified at 3.25 and now the rates are at 5 and it's now going to be a $400, $500, $600 additional monthly payment. You know what, team, we got to work. And when I say we have to work, what I mean by that is we have to go back to the basics of explaining to them if they're renting and they buy a house. Once you buy a house with a fixed rate, what happens to your payment, Paul, if it's a fixed rate? Nothing. What happens to your rent if you rent in your market? I mean, I was sitting in a meeting yesterday and they were saying the last 3 rentals that they were working on with their clients had highest and best for a rental. Highest and best.
Yeah.
Okay, so if you're renting and you're renting now for $2,000 a month and you're buying at $2,700, okay, number one, in 2 years your rent's going to be higher than your mortgage, especially if the rates don't drop and you refinance. Number two is the components of a mortgage payment. Who knows what the components of a mortgage payment are if it's a single family house and not the lenders? Who has a mortgage? Raise your hand. What's in that mortgage payment? Principal, interest. So your principal, interest, taxes, insurance. So how many of you have ever gone over this with a buyer? Principal is for savings, right? So if you're paying 500, if you're paying 2,700 a month and you're paying 400 of principal, your net payment is what? 2,300, right? Now, if you're paying $1,400 in taxes and interest, well, in New Jersey, let's say if you're paying 900 in taxes and interest, what is that? That's tax deductible, right? And what does tax deductible mean? It's subsidized by the government. So you're paying 900 a month in taxes and interest. You're at a 35% tax bracket. That's another $400. So you take your 2,700, you subtract 4, and then you subtract another 4. That's 800. You're now at $1,900. Okay, and you're paying 2,000 in rent. Your 1,900 is going to be fixed or improving because your principal over time. Does that go up or down, Paul, in your mortgage? Your first payment, how much principal is there? A little bit, right? And then when you're 10 years into it, it goes up. So I don't think we're having these conversations with our clients. I don't think they understand. I think they're in many cases transacting completely on emotion. And when they do that, they generally make the wrong decision. Okay. And now is the time to sort out the serious buyers from the non-serious buyers. But the only way we can do that is by having value-driven conversations. When's the last time anybody on this call took a buyer and had to explain to them the benefits of home ownership? We didn't do that. Right? And if they're renting and they're considering buying, you know, now is the perfect time. Rates are reasonable. If they drop, you refinance. If they go up, you're a genius, right? Because you took advantage of the rates today. So
Yeah, I want to say one thing. First-time home buyers, Rob. We have obviously we have these conversations all the time. You know, there was only a 2% drop last month in first-time home buyers. So, you know, but the first-time home buyers, they understand the tax benefit, but they really don't understand the significance of what, you know, how much they're going to save. And when you do illustrate that at them, they're surprised. Also, move-up buyers, you know, even though they're used to having a tax deduction and what have you, it's not something they typically look at, but at least they get it. First-time buyers are. I'm shocked how many, they all know there's a tax benefit, but they don't realize how it tangibly applies to them. And in some cases, it's $100,000 more home for the same price, or it allows them to go to $500 higher when they look at the tax benefit. It's very important to talk about that now.
And mortgage payments are still lower than rent payments. Rent has never been higher. I think another component, when the stock market goes down, it does not mean the real estate market is going to go down. What it means is investors see more value in real estate than they're going to see in the stock market. So when they're making offers on property, they're competing with investors who see the value in buying now and see the value in buying and renting because they're going to get such enormous amounts of rent. I think we need to be better at painting the picture of what's going on rather than letting them just run with what they see on the news and on the internet. You need to have facts. You need to have some, some documentation to show them, but it is there.
So Colleen, there's one other benefit that I didn't build into the buyer side. I was looking at it from the seller perspective, but I think it needs to be addressed here. So, and I'm looking at you, Paul, in the corner. So if you have a client that bought a home 2 years ago, right? And they bought it for $300,000 2 years ago, what do you think that's probably worth now? So it's 600, right? Now, Paul, let's say that person bought a stock position for 300,000, and let's say that stock position, let's assume that stock position doubled, right? So let's say that they bought a stock that's actually up. Let's say they bought a stock and they bought it 3 years ago and the stock doubled from 300 to 600. You go to sell that stock position, right? You have a gain of how much money? $300,000. You sell your house, you have a gain of. Now, once you get that $300,000 from selling your primary residence, how much tax do you pay? If you're married, under 5. If you're married, it's under 5. So if you're married, it's a married couple, you get a $300,000 tax-free. When you sell that stock, how much of that's tax-free? It's all taxable. So your net effect of the sale of your house is even multiplied more because you get to be tax-free. Now, my initial context for having this discussion was if somebody bought that house 3 years ago and they're up $300,000, $400,000, $500,000, right? Let's say the market continues to rise, right? And in another 3 years, it's up another 500,000. How much of that next 500,000 is tax-free? 0. If they sell it now and then they wait 2 more years, they get another 500,000 tax-free. That's huge. And when somebody says, should I be selling now? That should be part of our discussion. Say, you know what? You had a great run on your property. If we take advantage of this right now, check with your accountant, but I believe it would be a tax-free gain. And then if we buy and the market continues to rise, you can get another tax-free gain in 2 years.
I also want to know what stock. Not capital gains.
But I mean, I just think it's a mindset, Paul, because, if somebody says, I'm investing in stocks for wealth, and I'm investing my home to live in, well, ironically, there's a lot of benefits that are built into the tax code for home ownership. Not only are the benefits inuring to you while you're paying taxes and interest, right? And then what you're paying in taxes and interest is principal, which is forced savings, and the only other expense is insurance, and you should be carrying insurance on a rental as well. So there's really everything about it is positive. And if you lock in a rate at 5 and they drop, you can get the lower rate. And if you lock in a rate at 5 and it goes to 8, you're a genius.
It's the same conversation for a buyer, Rob. If you have a buyer who, is considering, maybe investing $100,000, if they could get a 10% return, right now they're getting a loss. Would you rather have a 10% return on $100,000, or would you rather have a 5% return on a $500,000 home? The asset's what's appreciating. So there's the same dialogue you could have with borrowers that right now they're at, the assets that they have in the market, if they don't go up that little extra amount and buy that house, are dropping like crazy. Whereas if they buy the house, even if it only appreciates 3 or 5% a year, the scale of what's appreciating is the whole house. The leverage piece is incredible. So it's the same conversation for the buyers.
your commentary is very well positioned, Bruce, because Paul, if a client buys a house for 500, right, and they put 20% down, how much is that?
100 grand.
Okay, so that's $100,000 down. If that house appreciates 10%, what is it worth in a year?
50.
550, right? So their 100,000 is now worth 150. So 10% appreciation is a 50% return on your cash.
If you had 10% in the market, you'd only pick up 10 grand on your cash. If you had the 100 grand in the bank and you get a 10% return, it's 10 grand. If you have it in the house, you get 50 grand.
Yes. The question was, is there anything going on at the federal level to toss the SALT tax, the $10,000 limit? And I think
Only my prayers every night. That's it.
so. I think right now, from what I've been reading, is the answer is no. And they have all the houses, and they don't have any will or any capacity to do that. So I think you need to consider it to be limited to that 10,000 and factor your math in that way. Now we're right on target. Now it's 10:02. We're going to the seller side. Okay. Robert, did you have something you wanted to contribute?
I do, yes. So as some of you know, I had a closing last Friday. That's why I wasn't on the call. But here's the outcome of it. A house in Mountain Lakes, we listed it for $1,675,000. We ended up selling it for $2 million. And when I arrived at my seller's new house to notify them that the closing had taken place and we were closed, and the two of them, who are not visibly emotional people, jumped up from the table and threw their arms around me and said, what you did that was most important to us was make us understand that it was better to get on the market early, even though it was not the season, and two, to put a price on it that was lower than what we wanted in order to drive the most amount of people to the house. And so when we put the house on the market, there were only 8 houses on the market in Mountain Lakes, and only 2 of them in our price range. So, and our house was located in the middle of town. It wasn't a house on the lake, which is always the high profile houses in the town. So we got $2 million, and on closing day, there were 5 new houses that had come on the market that were all lakefront houses, and they all were listed for less than what we sold our house for. And in speaking to some of the other agents, you know, there were conversations like, wish we would have known what your closing price is before we priced our houses, because we're not getting that kind of, you know, acceleration in pricing like you got. So, you know, the two takeaways are that I've been working with these people for 15 years. And over the 15 years, they've given me over $15 million worth of business. So during that period of time, I've established rapport with these people that we're at the stage now where, you know, if I tell them, look, this is the reason to do something and why, it's not even an argument. It's okay, where do we sign type of thing. And that's what we're all looking for in this business. You know, we need to, like we're talking about educating our buyers for this market, we need to be doing the same for our sellers. And from every viewpoint. So I wanted to mention that. You know, Daryl Davis talks about, you know, tell stories to help people understand the points. That's what I do, and I hope that you understand that I don't do this to show off what I do or I don't do, but more the things that work that we need to be doing with all of our buyers or sellers.
And Robert, the other thing that I see from that story is, as a seller, and that's a great segue into why, why sellers should be putting their house on now. Because inventory levels, just like interest rates, when that rate went from 2 7/8 to 3 3/8, so like, oh, the inventory is up a little bit, the interest rate's up a little bit, but that's probably going to move to a more normalized market. So even if you didn't time the bottom, let's get it on now before there's 15 houses in that price range, right, Robert?
Exactly.
A lot of people are going to see that $2 million sale and they're going to say, maybe it's time for me to sell, but the space is going to be crowded, right? There's going to be 15, 20 houses on the market, and you've already cleared out one of the qualified buyers.
Right.
So that's a great segue into the next step. And I'm going to give a little comical relief to the call as Bruce was at our sales meeting yesterday, or our mastermind, and he said, if my house goes up anymore, I'm going to convince my wife to sell. And when she says, where are we going to live? We're going to the bank and watch the money in the account.
No, she said, where are we going to go? I said, go to the damn bank. Just sit there and look at the money.
That was a funny comic relief there. But I mean, it is getting to the point of something
laugh.
being ridiculous.
Bruce, you can live in the ATM part.
She didn't laugh. She said, we're not selling.
So don't call Bruce. But anyway, let's look at the sellers, right? The homeowners right now. Is it a time, I think there's been a wave of homeowners that have felt like I get rewarded by waiting. Are there a lot of you out there that feel that, homeowners up to this point maybe feel like, hey, Ron Piccolo, if I would have sold last year, I would have left money on the table. And that there's still a little bit of that belief out there. But I think at some point, there's going to be an inflection, just like there's going on in Mountain Lakes, where there's going to be inventory driven on because prices have gone up. Okay, there's going to be balance in buyers, and ultimately, economics has to play a part in the value of a home. I'm going to repeat that. Economics have to play a part. It's not only emotion. At some point, if somebody's buying a home, it comes down to, can my family and I afford this house? Okay, prices are going up. Interest rates just went up. Now, interest rates went from 3 to 5, okay? That's a 2% rise in interest rates. But if you look at the percentage, okay, you take 5 divided by 3, that's a 67% increase in your interest payment. Does everybody understand that? That's not a 2% sounds fairly manageable, but if the interest rates went up 67%, does that not sound a little bit dramatic? And if that interest component of your housing payment went up 67% and the house price goes up, where does affordability break? Right? I mean, I think most people, even though it's an emotional transaction, economic value of it is playing and weighing in heavily. I'm going to guess that virtually everybody on this call who has more than 3 buyers has had at least one other buyer have to adjust expectations because of the change in the interest rates. Either, they didn't feel like they can afford the payment that they were qualified for, or they no longer qualified for what they qualified when they started, right? And I'm not going to ask for people to say it, but if you have 3 buyers, I'll bet you 1 out of 3 of those have been impacted from a practical affordability standpoint. I see you shaking your head, Ron, right?
Yeah, I have that a lot. I get that, buyers are worried about being able to afford a house at a higher rate. The question that they keep asking me, when I mentioned to them about refinancing, they say, well, what if the rates never drop and they keep going up? And I'm locked in at 6 or 5. And if they don't come back down, then I'm stuck with this payment where I thought I could afford, and now I'm house poor. So That was some of the objections that we're getting from some of the buyers that we had.
All right, so Ron, I'm gonna take that to a positive level. Okay, I'm gonna turn lemons into lemonade here right before you. Because if somebody comes to you and says, hey, Ron, what happens if interest rates continue to go up? They never drop again. I'm stuck with this higher payment, right? So my response then would be, okay, does that mean you would never buy a house? If you went and bought a house 2 years later, you'd be paying 6 or 7%, and you'd probably be paying a higher price and a higher rate. So this is the Goldilocks scenario for a buyer, in my opinion, and we need to be able to have this discussion. If rates go up, aren't you going to feel glad? You're going to feel like the agent in Bergen County that locked in at 3 3/8 before the rate went to 5, right? You're going to feel good about that. And you're also
Value of the house too.
well, I mean, even if the value of the house doesn't go up, just the fact that you're in there at that lower rate, right? So if you're in there at 5 and rates go up to 7, you have something that nobody else can have. You have a 5% mortgage rate. Now, we talked about if rates go back to 3, what are you going to do?
Finance, of course.
So Ron, what's the problem?
Oh, I mean, it's not a problem. It's just something it's an objection you have to overcome.
Well, no, but can you see how, and I want you to press back, if you don't see it, I'm turning in both ends into a positive. If interest rates go up, okay, that means that there's probably still inflation. That means that that's the new norm. And let me ask you, anybody who's getting a wage right now, anybody who's working at a service industry, anybody who's working in industry, what's happening to wages now? Ron, what's happening to wages?
Oh, well, I guess they're pretty good. They're going up, I guess, right now.
5-7% increases in wages, right? So your mortgage is going to be fixed, your income's going to go up. You have the perfect scenario here, Ron. Like, I just don't think we're sharing that with our buyers who are like, what happens if the rate doesn't go down? That's great. If it goes up, you're a genius. Because you're going to feel good that you locked in at 5 when it goes up to 7. And if it goes back to 3, you win. It's like heads I win, tails you win, you know? Either way it lands, we win both ways. And I don't think we're sharing that enough. I think we're allowing the buyers to control the narrative, and that's limiting their ability to take advantage of a temporary or permanent change in the inventory levels.
Yeah, I use a lot of the, if you invest in a property now, even at this rate that you're at 5% or whatever it is, a year from now, your house is going to be probably worth another $100,000. I use the narrative that Bruce was just saying before. It's better than putting your money into the bank or putting it into a stock that you don't know where it's going to go. But real estate is your best investment. That kind of convinces them to, go forward with the sale.
But people don't realize if you put 20% down and the home goes up by 10%, that's a 50% return. Okay, I think it would be helpful for us to take our serious buyers and go over the math with them. Okay, because heads you win, tails you win is a good scenario for a buyer. Rates go up, you win because you locked in. You're one of the smartest people that I know. And if rates go down, you're taking advantage of lower rates. Like, we need to have these conversations. If we're not, we're letting the buyer say, let me sit by and wait for the crash. There's no crash coming.
If you have them, if you're concerned about getting a little too granular, like somebody mentioned, the SALT tax and state and local tax, there are some caps on how to calculate the savings. Just know enough to speak about it, and then you could always ask them to reach out for us. We all are familiar with this as lenders, and we could go over it a little more detail with them as well. But it's definitely something that they don't know about, and it's important.
All right. Somebody has a question? I see you put your hand up. If you do.
Yes, I am new. I have one question about how about investment property? Let's say their property it's like 4 or 5 units, and their rate cannot be locked for 30 years or 15 years, only like 5 years, like 5-year ARM or 7-year ARM. What about that kind of situation?
So it's good that you asked that, because investors don't get the same advantage. Okay, investors generally have prepayment penalties. They can't lock in for 30 years. But that's the same as if it was, you know, if you locked in a 4%.
Investment money on residential real estate, we lock in for 30-year term all the time now. Commercial loans, like if you're buying commercial building and it's not residential, that's where you're going to find your 5 and your 7-year adjustment products.
She said over 5 units, Bruce, so that would generally be non-residential. So that highlights the benefits that, you know, 98% of our buyers are able to take advantage of, which are the laws that don't allow you to charge a prepayment penalty on a residential. The benefit of inexpensive refinancing. There are just so many benefits on the purchase side. On the investor side, I think we'd have to have like a 12-part series to try to figure out where that market's going and, you know, cost of funds and everything else. And the good news about that is a lot of your investors, they have their own strategies and theories and assumptions that they use when they make their investments. But for purposes of this, let's focus on the golden nugget that we have for residential home buyers, you know, you know, I'm gonna ask Paul if you can repeat back, like, what are the main benefits of that home buyer? Tax benefit, personal savings account as a principal, fixed payment, whether rates go up or down. If rates go down, you can refinance, right? You have, what if you put 20% down, the property goes up? You have leverage, right? If you put 20% down, you have 5x leverage. And there's one more, Paul, is tax-free gains. Like, I'm running out of fingers. And you have a house. Oh, hold on. You have a house and the rent doesn't go up like a tenant, right? The rent goes up. So there's a lot of benefits here, folks. And, you know, Paul, thanks for sharing. But like, you got to remember these things. If you don't remember them, sometimes we get buyers that are a little bit skittish. And I'm not saying everybody should buy now, but I'm saying everybody should have the benefit of us sharing the information with them so that they can make the right decision. Because the worst scenario for me is if somebody says, but Paul, if you would have told me that, I would have bought. Why didn't you tell me that? Like, how does that make you feel, right? It doesn't make me feel good if people are like, wow, if I would have known that, if I would have thought about it logically and said, you know, I own my house for 11 years, I'm up 500,000, I can cash out on my capital gain right now. And then if it goes up another 500, I get another 500 tax free. What, Paul, you never mentioned that. That could have got you another listing. And that's good for the economy. There's reason to put it there. Now we're focusing onto the listing side. And Rob Garber hit the nail on the head, which is, you know, if more inventory comes on, that limits our pricing power, right? So we're not going to get as much leverage and as many offers as we were getting in the past. Number two, most people who are selling are going to be doing what? I mean, most sellers are going to be buying unless they're, you know, selling their second home in Florida and not going to buy another one, which is unlikely. So most of our sellers are buyers. So everything leads back into that buyer conversation, which is, hey, you know, if you buy now, you have more options. Right now, as inventory is starting to build, you want to be one of the first people to come in and take advantage, just like the agent did before the rates came up, right? So I would even make the argument, Robert, that the people, those 15 people that put their house on right now, after your big sale, are probably going to do better than the next 30 people who are the second tier to come on, right?
Sure.
These are the discussions that we need to have with our sellers and buyers. So go ahead.
What about the sellers that want to transition to Christian but the interest rate? I have a seller now, she has 2.74. She refuses to sell now because the interest rate will be 5 points. So we rank her 5 points.
So maybe how long ago did you run those numbers? So good news is in 2 weeks, Bruce, rates are down, what, 3/8? You're on mute, sir. Bruce, you're muted.
Yeah, only about a quarter, Rob, just about a quarter.
So it's down a quarter, so it'd probably be closer to 5, so it'd be slightly less. But let me ask you, does she have a gain in the house that she lives in now?
Yeah, she's, I told her that
Okay, so,
she has to put 20% down. And then
and this comes down to a really fundamental question, which is there a reason for her to move other than just to like buy or sell a stock or buy or sell a house?
she just wanted, I got her like a townhouse,
Okay, planned unit development, yep.
right, and phases, and she just wanted now a single. Right. But she's like, that's almost, that's like really grand on top of my mortgage. She was like, why would I need to have 2.74 just to go buy at 5?
I think that is a challenge that, I think that is a challenge that's going to be in the market that we're going to be coming across, because even if they didn't buy within the past year, most people have refinanced, and unless they don't have any mortgage or a really insignificant mortgage, it's probably a conversation that comes on. But that's no difference than, you know, if you go and, you know, you want to buy a Mercedes-Benz versus a Chevrolet. It costs more, but you want to be in that car. If you want to be in a different house, there's a cost to it. Okay. Right now, if she's looking at single family houses, or he is, there's more houses to choose from, right? And then when they buy, they can refinance if the rates come down. And if the rates continue to go up, what she's done is she's moved into a new house at a preferential rate, correct? Now, she's not going to be at the 2 7/8 or whatever she was at now, but let's say that rates continue to rise and she does it in a year, and then now the rate's at 6. Is she going to live in the undesirable house that she doesn't want forever and do that? Another solution would be, how much equity does she have in the house? That's profit, but how much did she put down? Like FHA?
She put down, yeah, she put down the very minimum, 2.5.
So, I mean, offline, I might even talk about maybe you do a home equity line there. You take the cash out from the home equity. If you can rent it out and make money on that, then you buy a new house at the other rate, and you got your.
There's no more for that. That's a good option. I encourage people to do that all the time.
So there's some different, but look, I mean, not everybody has to buy. So that there are certain scenarios where when you have a conversation, it doesn't make sense for them, and you give them good advice and you move on. And sometimes you give somebody good advice that maybe now is not the time for you to buy because X, Y, and Z. By the way, do you know anyone else that I can help? They'd be like, oh my God, this agent told me that now's not the right time, but I want to refer my friends, because who does that? Right? So there's a lot more opportunities for us to stand out in this market, okay, when it shifts, than when we're just order takers and 52 offers on a house. And, you know, I look forward to the change. And if I'm wrong and there's not a major change, that's fine as well. At least we're all prepared for if change continues. And I think the rate discussion, if everybody takes one thing away from this, is you buy a house now, rates go up 2%, you're a genius. If you buy a house now, rates go down 2%, you refinance. You cannot lose, right? You flip the coin, you win either way, right? Now, if we have that conversation with 10 buyers, how many buyers are going to change their perspective on buying in this market, do you think? What would you say? Out of 10, would it be 2? Should be a 10, I have a 10 here, a big fan of mine.
If it's 1, it's worth it.
If it's one, it's worth it. But I mean, but if you don't have that conversation, I can guarantee it's going to be 0, right? And the customer, the buyer, is going to control the narrative. The buyer is going to have the story, the rates are high, the market's going to crash, all these demons in their head, when if you really break everything out, it's a very favorable market for buyers. It's also very favorable for sellers, because as inventory starts to go up, okay, you're going to have more competition, might mean less price appreciation. If rates increase and you are then in turn buying, okay, you're going to be buying in your new house at a higher rate. If interest rates rise, and buyers are paying a higher rate, they're going to have to adjust the price downward, right? So if you're selling your house and rates continue to rise, eventually those rising rates are going to cause buyers to pay less. That's inevitable. That's like gravity. Affordability is not limitless, right? So people can't just pay what they emotionally want to. They have to pay what they qualify for, and they have to pay what they feel like they can afford. So if rates go up, you know, and you ask a homeowner, you know, hey, Bruce, if rates go up, what do you think buyers are going to do when they make an offer? I think they're going to pay more or less. They're going to pay. Are they going to pay more for your house, or are they going to have to? Yeah. What's going to happen? What's going to happen to the price they offer you if the payment goes up because the rates are up? They're going to offer you less. But the trick here is you asking the seller to answer that question rather than you tell the seller. Because anybody ever see was it Charlie Brown? It's wah, 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 right? If you're telling them, the sellers are like ignoring you. But if you ask them and they say, well, you know, if the payment's going to be higher, they're probably going to make a little bit lower price so they can afford it. Bingo, right? When you get the homeowner, potential seller to tell that back to you, that gets you some leverage. And it's not manipulated. I don't think anything here, if this were played on CBS News, AB, like everywhere, I don't think anything that we're saying here is something that's not good for the industry, not good for the client. Is there anything deceitful we're talking about? Everything here is true. Everything here is ammunition to get people to take what's in their best interest. And if that is, you know, staying at that one, if that's her best interest, we need to be honest and say, look, you know, here's the reality. If it's not extremely painful for you to live in a planned unit house and, you know, single family is not worth paying that much more, then your right choice is to stay there. But if you defer it for 2 years and rates go up, it's going to be more painful to make that move. You need to be educated on that option. You need to know about what rents and mortgage payments do. You know, rents go up, mortgage payments generally stay fixed. If interest rates go down, they decline. You have a lot of other benefits. We haven't been talking about that in the past 2 years. We've just been panic buying. Right? We've been panic buying. We've been sloppy with our sellers. We put it on. If they want to overprice it, okay, we'll do that. No problem. Somebody will pay it. So any last minute questions or anything that you have that you want me to try to, you know, give you my perspective on, or maybe even better than me as some of your peers?
So Rob, I wanted to mention one other thing if I could. From a listing that I had in Randolph that sold last month, one of the neighbors of my seller reached out to me and, you know, said that, you know, my seller had, you know, raved about the service that I provided and everything. And that while he wasn't looking to do anything for a year, maybe two, when he was thinking about selling the house and moving to Florida, sorry, Colleen, they're already working with somebody in Florida. But you know, he said, so I don't think it's time for us to have a conversation right now, but you know, when the time is right, I'd like to be able to call you. And I said, okay, well, why are you waiting a year to a year and a half or 2 years? Well, you know, we're not really sure that we're ready to go, but I mean, you know, if someone was to come along and offer us, you know, an unbelievable number for our house, we could probably get out of here pretty quickly. And I said, well, if that's the case, then we should really have a conversation now, because there's never going to be a better market for you as a seller than there is right now. So I met with them. We had a really good conversation, and we're going to meet again later this week. And I have the feeling they're going to market their house pretty quickly.
Yeah, I applaud, you know, you have a very soft way of presenting information, Robert, which I think is disarming and allows people to evaluate it, you know, unemotionally. And I commend you for that. I know we had another question here.
Yeah, I actually, the more I think about it, the confidence.
Right.
It sort of applies in any market with any interest rate, right? Because you can always, if the rate's 7, you can always say, well, it can always go up.
or you can refinance if the rate is 20. You know what I'm saying? You can apply that under any circumstances. It works. Unless, you know, it's been the worst option, you know, but I think it works regardless of the.
I mean, I think that's an implicit function of the no prepayment penalties and residential mortgages being able to be fixed for an entire term. I think that's an implicit benefit to it, but I don't think anybody really thinks about it. So you're right, it is something that is good in both scenarios, but I think in the past, what we saw here where a lot of people felt like rates were going to continue to drop, so there was no urgency to buy, right? But I think now that they see that rates aren't going to be, 3% forever, that's a good thing because it creates an awareness and it makes that conversation a lot more relevant, right? Because when you talk to somebody about the rates being higher, I feel like I have a really good discussion point about, hey, you know what? Now there's 3 houses for us to look at instead of 1. We might be able to only pay 4% above ask instead of 12, and you might actually get the house that you want. And then if rates go down, so if you layer that conversation, I do agree. Any other questions or comments? So I want everybody to, well, I would suggest everybody go out to some of your buyers that you think are feeling a little jaded, a little bit on the fence, and set up a Zoom meeting, meet them in person, have a conversation about what the shifting market means, and tell them how that they can benefit, especially if they're a homeowner and they're looking to sell. There are so many different benefits. I'm probably gonna write this down and put it with the replay on our YouTube page so that you can reinforce all the things: tax benefits, owning, tax benefits if you sell. You flip the coin, either way you win with the interest rates, right? I mean, there's so many benefits. So we got to get back to talking about that instead of just, hey, let's go make some offers.
Next week is a lot of economic news. One of them is going to be pending home sales, which will measure all the contracts that were initiated in the month of April. So next week we'll have a little more news to kind of help us understand what that looks like with the rates being a little higher and everything else. They expect it to be barely off. So just an FYI.
So if you're sitting on buyers, I think the value of your buyers has increased and not decreased with the shift in the market. And we will separate ourselves if we have these conversations that very few, if any, of our competitors are having. So go get them this weekend, take care of your clients, and get some listings and sales. Have a great weekend.